Last episode, we said your portfolio might be 80% stocks and 15% bonds. But what does that actually mean? When you buy a stock or buy a bond, what are you really getting? These two things aren't just different risk levels, they're completely different legal relationships. This is Episode 6 of the Finance module in the Business Notebook. If you missed last episode on asset allocation, go watch that first. This builds directly on it. A stock is a small slice of ownership in a company. When you buy one share, you literally own a tiny piece of that business. If the company grows and becomes more valuable, your share becomes more valuable too. If it pays out profits, you might get a dividend. But if the company goes bankrupt, shareholders are paid last, after everyone else. That's the trade. Unlimited upside. But you're at the back of the line if things go wrong. A bond is the opposite. When you buy a bond, you're not an owner. You're a lender. You're loaning money to a company or government, and in exchange, they promise to pay you back the full amount on a set date, plus regular interest payments along the way. If the company goes bankrupt, bondholders get paid before shareholders. Less upside, but a much stronger claim on getting your money back. Say a company issues a bond worth 10 million dong at 6% annual interest for 5 years. Every year, you receive 600,000 dong in interest. After 5 years, you get your original 10 million back. Total return, predictable, contractual, spelled out in advance. Now compare that to buying 10 million dong of that same company's stock. There's no promised payment at all. If the company doubles in value, your 10 million could become 20 million. If it goes under, your 10 million could become 0. No guarantees either way. This is exactly why portfolios mix the two. Bonds provide the predictable, contractual income. Stocks provide the growth engine. When stock markets fall, bonds often hold steady or even rise, smoothing out the ride, which is the whole reason last episode's allocation percentages matter so much. One common misconception: bonds aren't risk-free. If interest rates rise after you buy a bond, its market value can drop before maturity. And if the issuer can't pay, you can still lose money. Bonds are lower risk than stocks. Not zero risk. Stocks make you an owner betting on growth. Bonds make you a lender counting on a promise. Next episode, we go back to Episode 1's time value of money and use it for something practical. Deciding whether a company should actually invest in a new project. That's NPV and IRR, Episode 7.